Good morning. It's Sunday, May 4th, 2025. It's almost 11 a.m. on the East Coast, 8 a.m. on the West Coast. And this is Robert Sin at CEO Technician on X, at Goldfinger on CEO.ca. And this is Goldfinger Capital on YouTube. Going to try my very best to get this done in 30 minutes. It's always tricky. So we're going to go fast. Last week, just quick summary, the last couple of weeks I've been bullish on stocks, basically saying don't fight this rebound, dead cat bounce, or whatever you want to call it. It's clear to me that the forces at work out there are have a strong interest in seeing stocks rebound and investors relax and calm down a little bit after the early April upset. And that's what's happened, right? And so we've had a 3-week rebound rally, which is now getting pretty long in the tooth, actually. And if we look at the E-mini S&P, here's April 2nd, here's Liberation Day, here's that afternoon candlestick as the president took the stage at 4 o'clock on the East Coast, Wednesday, April 2nd. And we know what happened over the next 5 days, right? It was just a complete swoon. You could even call it a crash, quite frankly. And then, the rebound, obviously, with the pause, the tariff walk back, and we've been grinding higher ever since. And now we're back to this 5,700 level. Actually, the high on Wednesday, April 2nd, was 57.7325 in the E-mini S&P. And I actually think that maybe we have a little more to go early this week, Monday, Tuesday. Maybe we can get up to that 57.73 level. But I feel like this rally is really getting long in the tooth here in mega cap, large cap, U.S. equities. And this is kind of how markets, the rhythm of markets, right? You have like a catastrophic week, you have a crash, you have a stock market meltdown, get everybody negative, everybody afraid, and then the market comes back, right? A lot of the crowd is caught off sides, or the crowd has been panicked out at the low because they were watching their Twitter feed, and they were watching the news headlines, and they saw their portfolio value drop, and they got fearful and they sold it low, right? And then that's the exact wrong time to sell it. Now we're back up here, and things are looking a little better. Friday's jobs numbers were better than expected, right? There's some optimism on tariffs and trade deals and what have you, right? And so this is kind of how the narrative molds itself to the price action. But just keeping it simple, we're all the way back to before the meltdown happened. What has really changed? Yeah, I mean, the timeline for the whole tariff thing has been pushed out a bit. It's very unclear how the situation is going to resolve. I don't think anybody knows how some of these trade deals are going to get done with, like, the EU, for example, where, the US and the EU have so many disagreements over trade. I don't see this being resolved in less than 12 months at minimum, right? But most likely they will kick the can. But there's always a potential for the rhetoric and things to heat up again, right? If the disagreements get too pronounced, sides are not willing to compromise at all, then what's really going on here, right? Maybe this week, so the Canadian Prime Minister is going to go to Washington on Tuesday. Maybe this week there will be a positive headline on Tuesday, and that will be, the sort of climax to this rebound rally. That'll be the inflection point on the upside. It's quite possible, I think. And then we have a Fed announcement on Wednesday. It's probably very anticlimactic. There's not going to be anything that's going to happen, but Powell is probably more likely during his press conference to not be a risk-on voice. Okay, I think his press conference in March was generally kind of downbeat. I mean, certainly, I don't think you would want to buy stocks just because you heard his press conference. I think quite the opposite, right? And so I think there's probably going to be an inflection point this week, Tuesday, Wednesday. Maybe we get a climactic blow off sort of move early in the week, Monday, Tuesday, and then Wednesday we start to turn lower again. That's sort of how I'm handicapping this to play out. Again, strong opinions weekly held, but just keep it simple, stupid. We're all the way back here. We're at resistance. This is not the time to be taking more risk or adding risk, right? Looking at the SPY daily chart, maybe we get all the way up to this green moving average, the 156-day flat moving average. I mean, look to the left, 575, 576. So that would suggest there's still another maybe 70, 80, 90 points of upside here. That kind of aligns with that 57, 75 area. It's close enough, right? So I would be looking to take off risk on a further move to the upside and then begin looking to lean to the short side middle end of the week. QQQ, very same setup. I mean, 493, 495, that's resistance. Yeah, I sell. I'm a seller there all day long. And then just some of like the options activity continues to be very aggressive to the bullish side. Retail buying calls at a more than 2-to-1 ratio over puts at the end of last week. Just not the time that you want to be taking risks. Just some of the stuff that's been going on. And yeah, retail actually did well in April. They most of them seem to have taken more risk on the market panic and probably have done well. Although with all that the leveraged ETF volume and inflows, well, that's also bear ETFs too, right? So it's hard to parse out exactly how retail did overall, but most of the data, the accumulation of the data shows that retail investors bought the dip, quote unquote, as they've been trained to do for the last 15 years. So far, it's worked out, but I wouldn't look a gift horse in the mouth here. If you did buy the dip, I'd be looking to take profits early this week. MicroStrategy, this is sort of like one of the poster childs for the risk on attitude of this market, and we're at resistance. I mean, just look to the left on the chart here. We're back to the 400 level in MicroStrategy. Yeah, it's a well-defined uptrend. It keeps grinding higher. However, we want to buy low, which was early April at 235, and we want to sell high, and that would be above 400 for sure. If there's some areas of the market that I still see some possibility for further upside here in May, it would probably be Tesla. They're going to have this RoboTaxi launch in Austin in June, although the details are never clear with Tesla, and they could change the timeline. But they've messaged this enough that I think at least there'll be a relatively small rollout. I don't know how many vehicles, but just sort of a proof of concept thing. And if they can show that proof of concept, if they can prove it, then I think that's big. I think that's a big catalyst where you could be looking at billions of dollars in revenue in 2026 from a larger Tesla RoboTaxi rollout, right? So just from a chart standpoint, this looks like a pretty well-defined bottoming pattern. We're pushing up to resistance near 295 to 300. But I like the chart technicals here. I feel like that March, April swoon was really a capitulation watch out, and that is a double bottom here, right? So any chartist can see that, right? That's a double bottom. So I don't know. I think for example, like long Tesla, short QQQ might not be a horrible pairs trade. And then I am long OIH, as I've alluded to last week. This is definitely a contrarian trade with what's going on in the oil market. Super contrarian, quite frankly. The outlook for oil is pretty negative, and OPEC is increasing production into falling prices. I'm not going to get into that again because I want to keep this video to 30 minutes, which is never easy. But this is just simply a contrarian trade setup. I believe that early April was an absolute capitulation crash washout in the energy stocks, and they're slowly putting in higher lows. And now maybe that will transition two higher highs in the OIH above 220. And sort of my upside here is to get up to 235, 240 area. I'm in from 213, 214 cost basis, I believe. So in the green here and looking for another, I don't know, 7, 8, 10% of upside here, sort of a mean reversion trade setup, swing trade setup in the OIH. Jobless claims. So I know we had a better than expected monthly non-farm payrolls report on Friday, but that's the revisions were lower to February and March. The revisions actually exceeded the beat versus consensus. The unemployment rate did tick higher. If you actually drill down on the data, it did edge up 3 basis points in April. So regardless of the media spin, the April employment report, even as doctored up as it is, shows a softening labor market, not like a terrible labor market or like a recession, but it's softening. And then if we look at the weekly claims, well, we're in an uptrend here, and I know there's been uptrends before, but if you just look at the data since the middle of last year, the market, the labor market really improved in Q4. There was some sense of optimism. Obviously, we had that Fed rate cut in September. But now if you look at where we were like October, November to the average weekly jobless claims here in the last couple of months, it's clear that it's picking up, right? And in the in April, well, here you have a pretty clear uptrend. Now, 2 weeks, 3 weeks is not enough to really make any major assessment about the future trajectory of the US labor market. But if we get another uptick above 240K, certainly if we get a 250K print next week or in the next couple of weeks, I think that's a sign. That's enough evidence that we can start saying, okay, this is actually a weakening economy, and the labor market is suffering a little bit here in the U.S. Turning to gold, first weekly gold outflow since January. So just put that into perspective. Like there were no outflows in February, March, and through most of April until the very last week of the month. And you can see just how much money has flowed in here in early 2025, and for good reason, quite frankly. So the first outflow last week actually aligns with the Barron's cover, an article that, Gold Rush was the title. It was a gold focused article, but it wasn't wildly bullish or anything. It was pretty balanced. So I don't, this, aside from just being gold on the cover, I don't think it was a great contrarian indicator, but good enough. Barron's put on the cover. I blogged about it yesterday. Check out my Substack. I put a lot of effort into this piece, just sort of delving into the bigger picture situation for gold, the setup, and then Warren Buffett's comments yesterday at his annual shareholder meeting, Berkshire Hathaway annual shareholder meeting. Things could happen in the US that would make us want to own a lot of other currencies. Those are big words from a man with hundreds of billions of dollars of T-bills and loads of cash um, in his treasury, right, in his pocket, essentially. And, he is an American patriot, right? This is a guy who stands for American business and the most famous investor in the history of the world, in the history of the US, and a real legend, right? So those are big words. And it's interesting that the president is out today, the day after, saying he's not going to fire Powell. I think the message was heard there that you really don't want to mess with Fed independence because the consequences, the ramifications would be far-reaching and very, very negative for the country. But still, it's no secret that the president wants the Fed funds rate lower, and he would prefer a different Fed chairman. And surely we will get one a year from now, right? But I kind of just delve into all the reasons why the bullish case for gold is very much intact, how there's still so much uncertainty, despite the fact that we can paper it over and put a pause on things and extend and pretend and kick the can. The fundamental imbalances and unease is still very much there underneath the surface. And, this new administration has made it very clear um, that China is the enemy, right? And so that's big. And gold is a very important part of China's counter to the U.S. and sort of its plan to match and maybe even exceed the U.S. dollar as the reserve currency in the future. And quite frankly, this administration seems okay with the dollar reducing its role as the reserve currency and getting weaker, quite frankly. And I show this chart, US dollar index, 40-year chart going way, way back, and just make the points that we may have just seen a major inflection point here in Q1 2025. And if it actually proves to be a new leg lower in the US dollar, there's a lot of downside to go. And the expectation would be lower US dollar, negative correlation with gold, so higher US dollar price of gold. That's uh, gold and financial markets 101, right? Basic stuff. And I'll won't spoil the rest of it for you. Go ahead and take a look at it. The fiscal situation in the US also has not changed in the last month or the last few months. In fact, it's deteriorating even worse. So, despite the rhetoric, the deficit continues to grow. Just from a technical standpoint, yeah, we got a MACD bear cross here and gold. So some more downside over the next couple of weeks would be expected, quite frankly. 3,200 is support. You can see we bounced off that at the end of last week. So that's the first downside level. And then I would say somewhere around 3,140, 3,150 would be the next level. If we get through that 3,140, then there's probably at least another $100 of downside, getting down to around 3,000 to 3,050 area. But in the grand scheme of things, this is the trend, and a correction back to the trend, which in this case, I would say the 40-day moving average is a pretty good gauge of trend, 3130, 3140, standard, healthy stuff in terms of the technical health of the market. US dollar index daily chart, well, that's a downtrend, and we're just rebounding from a very oversold condition there a couple of weeks ago. Could this rebound back to 101, 102? Absolutely. That would also align with probably further deeper correction in the gold price. But the trend is your friend, and I don't think we want to be fooled here. The trend is not up in the US dollar. There's a lot of forces out there that want the dollar lower. The trend is lower. Keep it simple. Stupid gold miners, very similar to the gold chart. Huey Gold Bugs Index in a correction. So far, it's a garden variety, not a big deal. Maybe the Huey gets down to 360 if the correction in gold gets a little deeper. I would view that as a tremendous buying opportunity. Treasury yield curve. Oh yeah, so this is kind of aligned with my thinking on the US dollar index and the bigger picture cycles favoring gold here. Well, Treasury yield curve is steepening after reaching a historically deeply inverted condition in 2023 and staying inverted, although less inverted throughout much of 2024, and now just normalizing and steepening to the positive side, right? Yeah, so 2-year yield is lower than 10-year yield, as it should be, and as it historically has been. But this movement from an inverted yield curve back to a much steeper yield curve has historically been very positive for gold and for the gold mining sector. So 2002 to 2004 was a tremendous gold miner bull market. 2007 to 2011 was another one. Obviously, there was a little bit of a global financial crisis in the middle there, but overall, that cycle was very favorable for gold and gold mining stocks. And then we saw that again in 2019 and 2020, right? And so here we are again Keep it simple, stupid, right? And where are we in the gold mining bull market? So again, keeping it simple, stupid. I just look at the M&A deals of the last year. So Anglo Gold acquired Sentiment. That's a producer of very good gold mining assets in that company. They paid 2.5 billion. Not extreme considering the gold price, the quality of the assets, right? Gold Fields acquired the portion of the windfall deposit, a Cisco that it didn't own, 1.4 billion. Again, that's a producing asset. And then, Equinox and Caliber merger, right? A stock deal, a merger of not quite equals, but a merger of producing assets. So these are all producing assets, and the valuations are reasonable. There's no overpaying going on here. So none of this is characteristic of the sort of froth and excess that I think we see at the top of a bull market. When we really got a top in 2011 and 2012, well, there were some crazy deals and price tags paid. I mean, just think about Kinross buying Redback for 7.1 billion. So that the flagship asset there was Tasiast, which is now, Kinross's like top asset, but this was 15 years ago, and paying 7.1 billion for that. Newmont acquiring Frontier Gold for 2.3 billion. That turned out to be a terrible, terrible deal. And Areco Northgate for 1.5 billion. Again, the assets in these companies were fine. They're actually pretty good assets today still, a lot of them. It was just the price tags paid at the time. When you inflation adjust US 1.5 billion in 2011 to today, that's a huge price tag to pay for one gold asset that's not in production, right? And there's a couple of other ones here. Again, the assets that were acquired in these companies were quality assets. There's no question about that. It's just the price that was paid. When you inflation adjust these price tags to today and then compare them to some of the deals that we've just seen happen, this was overpaying. You could argue this was underpaying here in 2024 and 2025. Let's keep going with the gold mining theme. So Kinross and IAMGOLD report after the close this Tuesday. I'd be interested to see the Kinross report because it's held up. The share price has held up very well here in the last couple of weeks as gold has been under pressure. If we just read the tape, Mr. Market is telling us this should be a good quarter from Kinross. Kinross caught a couple upgrades in April, including from BMO. BMO also upgraded IAMGOLD, and IAMGOLD will report quarterly earnings also Tuesday after the close. Now, IAMGOLD has been under more pressure than Kinross for sure. Obviously, IAMGOLD is a smaller producer, but the difference in performance between these two is really notable. With Kinross, it's barely a 10% correction. With IAMGOLD, we're well into the 20% level, right? So it's 2x to the downside, and maybe that's a size thing. Just investors, the market views IAG as higher beta, so it sells it down a lot more. On gold declines, it buys it up a lot more on gold price rises. We will see. IAMGOLD is, this is supposed to be a big year for them with attributable gold production of about 800,000 ounces full year. But the first quarter is not expected to be the blockbuster. In fact, costs will probably be a little higher this quarter as Côté ramps up. So that's something we'll keep an eye on. But if you see like 1750 or 1800 on the cost side from IAG in Q1, that shouldn't panic you. This is what the guidance is, and it's going to be a back half loaded year as Côté ramps up. But I'll be definitely watching for those reports from these two producers after the close on Tuesday. Both of them definitely on trade radar, and I am long IAG. And now juniors, this is Onyx Gold. So this is a bull market adjustment trade. Look on my Substack if you have not read the post before. Search bull market adjustment trade. Search TA and junior mining. I've got a bunch of articles about this concept, and this is a very clear bull market adjustment trade that has been playing out in Onyx Gold. And the fact that this company is now getting the drill back to the Argus North, target area, where this new discovery was made. Here's the discovery, 3.4 grams per ton gold over 69.6 meters. This is a new zone that they basically tagged into and made a great new discovery, right? The fact they're getting the drill back out there basically right now, this week, that's great because there's no real gap in news flow. Sometimes companies will put out a new discovery. They'll have sort of a great, news release, a game-changing event, and then they go silent for 2 or 3 months, and that's never a good thing because you have the potential to really capture the market's attention and keep it. And with a new discovery, investors want you to follow up. They want, okay, like, is this real? Is it like, show us how big it is? Tell us more about it, right? So you have in this sector where companies wallow in obscurity much of the time, when you have that spotlight, generally it's worth using it, right? So get the money in, which they've actually gotten through warrant exercises, get the drill back out there, which they've done. So this is a very well managed company. The CEO is a sharp guy. He definitely knows what he's doing. So we'll see. They know exactly where they want to follow up. You can read this news release, take a look at the section maps, the plan maps. They're going to re-enter these two holes to trace this at depth, and they'll also test closer to surface, basically drill out this new discovery zone. And they've got plenty of room to step out along strike, this fault structure that they have here. The Pipestone fault. So this is in the Timmins camp of Ontario, Canada. They've got plenty of room to work with and see how big this discovery is. Check out the terms of the option agreement. They basically acquired a 50-acre parcel of land to add to their property package, but clearly this was a key section that they wanted to include. And the cool thing about it is that it's a patented claim, which is actually very rare in Canada today. Patented claim gives you surface and mineral rights and a bunch of other cool things. You don't have to get permits for every single thing that you do when it's just patented claims are way better and they're super rare in Canada. So that's why they kind of paid up here. If you look at the terms of this, for 51 acres of land, they're paying up. There's a lot of stock involved here. The vendor, I'm sure, is happy to see the share price at 80 cents based upon all the stock they're due to get, and rooting for Onyx to be a great new discovery because the vendor stands to do very well if it is. But Onyx, bull market adjustment trade, definitely one to watch. Ramp Metals. This was a bull market adjustment trade in 2024 when they had the new discovery. Maybe you could say this is part two now, since they put out this news release last week with the new VMS discovery at the Rush target. Again, check out my Substack. I have a premium post delving into this in more detail with my thoughts on Rush and Ranger and Ramp Metals more generally. Also, I think these Ranger holes, they just showed a couple boxes of drill core, but this is very interesting stuff. Obviously, we need to see the assays for all of this, especially the Ranger holes, because it's gold and the XRF is not good with gold, and you can't really see it in this core, right? So they need to get the lab certified assays to really know what they're dealing with here. But a very interesting news release from Ramp Metals, and the market took a liking to it. And then the company announced an above market financing on Friday. So smart management team, sharp guys at Ramp, definitely a story to watch. And then Talon Metals. So this one, we know Talon has like this ridiculous share structure with 1 billion shares outstanding. We know they need money. They need to do something on the financing side. We know those are the challenges: financing, share structure. All right, that's the negative stuff. But the positive stuff is that the Tamarack, nickel, copper, cobalt project is one of the best base metal assets in the U.S. It's, critical metals, copper, nickel, cobalt, they're all critical metals, right? And it's in Minnesota. So this is a special asset. And the company put out a special drill result last week, 8.25 meters, grading 48.87% copper equivalent. So Talon Metals had the highest grade drill intercept in the history of the Tamarack project. They just reported it. I have written about this before also on my Substack and talked about it in these weekly videos. But I'll just refresh everybody's memory that this map essentially shows this new area where this drill intercept was located. 8.25 meters, 12.62% nickel, 13.88% copper, 0.12% cobalt. And get this, 17.94 grams per ton platinum group metals and gold. That's just a really wild drill intercept. That tenor and all those metals, nickel, copper, cobalt, platinum, palladium, gold. I don't know, maybe there's some rhodium in there. I'm not sure. I haven't seen the full assay table. But anyway, that's a very special drill intercept. And it's located down dip and to the south of the main Tamarack area, massive sulfide unit. So it's not such a big leap of logic to maybe infer that this is the first intercept into a new zone that has to do with this, where basically these the waterfall of massive sulfides may have pooled in this area, right? And they basically allude to that in the news release and in prior news releases in March. Its position below the existing resource is significant as it may represent a potential pathway or pooling of massive sulfides into a new zone that could be laterally extensive, as it's an area with a lack of drilling. So either this is part of a pathway that leads somewhere else, or it is part of a pooling, sort of a keel, where these massive sulfides may have concentrated. And just the tenor of the mineralization is just so extraordinary. It makes it very interesting, because when you start to do the math, even if this new area is only like 50 meters by 100 meters by, I don't know, 30 meters, like something like that, with grades like this, it can host a lot of metal in a fairly limited, concentrated area. And that's how these sort of magmatic conduit hosted massive sulfide deposits work. And so this is just the tenor is so extraordinary that it makes it very interesting and very exciting. And they own their own drills at Talon, so they're following up on this. I'm sure they have at least a couple of more holes into this area, and we'll see what they report. Now, this is deep. It's 700 meters deep, so it's not like they can just get there with a new drill hole that quickly, but I'm pretty sure they're following up on it, and we're going to get news very soon on the follow-up holes. Again, the project is the highlight. The project is fantastic. It's the corporate share structure and funding that remains the big question marks around the company. And I'll just leave it at that. I'll definitely have more on Talon during the month of May. You can count on that. And just from a chart perspective, it was flat on its ass and it's picked up a bit, but still, the valuation is far from lofty, considering the potential that the Tamarack asset has, and also Talon's assets in Michigan. I'll make one other point about Onyx, in that also we've seen an increase in the short interest here in Onyx in the last week or so. So it's going to be interesting, because either those shorts are about to get squeezed, if they're actual shorts, or they're just people with warrants. And once we get through all this warrant exercise, then the lid will potentially be off this stock as drilling resumes in Timmins, right? So it's a very interesting setup when you have such a tight share structure. The valuation is still sub US 30 million. I mean, the market cap is still not even 30 million US after this run up, right? So far from a lofty valuation. Yeah, it's early stage. Yeah, the option terms were a little pricey, but the potential here is pretty extraordinary, quite frankly. And the fact that it's in the Timmins camp, if they're able to drill out a large gold deposit there, surely it's going to be quite valuable, especially with these kinds of gold grades. If they're able to find more of this kind of tenor gold, it could be potentially quite valuable, right? And then this is the Substack article in Ramp. So again, subscribe. $8 a month, $80 a year. It's basically free. Thanks for tuning in. I appreciate your attention, your interest, your viewership, and I wish you a very powerful trading week.